Good afternoon, everyone. This is Abhimanyu Arora from HBits. Thank you, everyone, for joining in this webinar Thursday afternoon. Today, we are going to cover one of the most important topic of SM REITs, indeed, which is basically a starting point where we actually look forward and how we acquire a particular property. So, with me is Sarthak Dhingra, who is head of acquisitions. I've just uh, invited him today so that he can just give us insight, deep dive view about the locations in India where we should touch base. We'll just go on with the particular slides. We'll try to keep the slides and presentation as quick as possible. And please, if you have any questions, please feel free to write in the Q&A, please. Just to start off, I'll just talk about something about our leadership team. So Shiv Parekh, who is the founder and CEO, he incorporated HBITS 2019. That's what we started. He's a undergrad from Harvard, BS engineering physics from Stanford. Uh, to talk about his experience, he's worked with Citi and Stanford Management, and he's as well known for Forbes 30 under 30 2022, as well as Business World Disrupt 30 under 2022. Well, around 3 years back, Mr. Sameer Bhandari joined us as a co-founder and CFO to accelerate growth and sales. He he's basically I'm Ahmedabad and a chartered accountant with around 33, 34 years rich experience in banking, worked with banks like JP Morgan, UBS, Bank of America, and most of the positions he's held is as a managing director. Uh, well, that's about him. Something to just talk about Sarthak, who is with us. He's actually done his MBA from ISB Hyderabad, and then he moved on to US, where he did his bachelor's and master's from Georgia Institute of Technology. He as well worked for around 8 years in KPMG in US itself in the real estate and infrastructure practice. And he was as well the head of real estate and asset management travel centers of America, which is basically a Fortune 500 company and currently which is in the portfolio of BP, which is Bharat Petroleum, British Petroleum, Bharat Petroleum. Okay, just something about myself. Me being one of the first employees at 8bits, overall 25 years experience, worked with banks like HDFC, HSBC, DBS, Singapore, and Kotak, purely into wealth and treasury throughout my career. And I did few courses from IIM Calcutta. Well, just to pull in Sarthak over here to start off, where in Sarthak, your expertise, where how we acquire the property, a little view, what we look at as a basic dynamics in selecting a particular location and how the market is evolving around these particular cities in India. Over to you, Sarthak.
Oh, sure. Thanks, Abhimanyu. So I'll just jump in, give a quick state of the market, right, and what happened in 2024. So 2024 saw some record leasing activity in India, which was about 80 million square feet, and that was a 16% year-over-year rise. So the momentum and the India growth story that we are seeing, it is continuing to grow. And the sort of expected year-on-year increase this year is supposed to be even higher than 16%. And at least from what we can see in the first half of 2025, that we should possibly surpass the record leasing of last year as well. And of course, this is what we are seeing is a good mix. That we are seeing a lot of demand, of course, which is great and healthy, but a lot of new supply also is coming in. And with that, despite the lot of new supply of grade A stock that's been coming in, because of the demand that we are seeing year on year increasing, the vacancy rates have generally stayed stable or rather been reducing. So overall, very, very good signs for the commercial real estate market. And of course, GCCs, global capability centers, have been, the backbone of office demand for us. But while that growth is continuing to increase, right, we continuously hear of new requests for proposals that our IPC international corporate consultant friends tell us about from the GCC sort of community. But one interesting matter point that I would like to point out also, that we're seeing a lot of in the Q2 of 2025, the most recent data, we are seeing that domestic institutions on the basically the technology side, flex operator side, and BFSI as well have been taking more supply compared to previously, which was being led by the GCCs. So this is actually a good momentum overall that we're seeing both that GCC demand, but also more domestic demand, and that's of course a good win for us. And of course, flex operators have really increased in India, and managed operators are also there. In fact, we have the highest flex number of desks in Asia. More and more companies are also shifting towards looking at the operator model where they do a managed office. So that's also good momentum for the overall commercial real estate market, especially from an investor standpoint, because then you're seeing more leases where a full building gets taken up by a managed operator, and then it's subleased out to pedigreed tenants. So it's a win-win from an investor standpoint as well, which is the lens that we are looking at it from. And of course, tier one cities have been in focus, but we're seeing, India, most of India's total office market, about 800 or billion square feet or so. 50% of it is within the top 10 sort of cities, right? And so Bangalore, Pune, Mumbai have been sort of actually leading the trend of late with terms of amount of space absorbed, and that happens to also be where HBITS has previously invested, right, in the prior fractional sort of model before we moved to SM REIT. That being said, we're also expanding our lens to look at other markets like NCR, Hyderabad, etc., where we're seeing good momentum. And as we talk about it, right, it's the looking at which micro market or tenant profile, building profile also becomes pretty important as we're looking at investments. So as this points out, Bangalore has been leading the pack, right? In fact, Bangalore's one of the markets, Outer Ring Road, where most of the GCC and other sort of grade A sort of tenant profiles, large occupiers exist. That has is one of the largest office micro markets in India, which has more stock than, in fact, Pune or Chennai for that matter. So even with that, with the new supply coming in, absorption has been sort of overtaking supply in almost every city that you can see, right? So except for Pune, and that's also because Pune has recently seen a huge uptake in new high quality assets that are coming up in, because more and more GCC demand has also started coming to Pune for the pricing aspect. So in Baner, Hinjewadi, and Kharadi areas, you're seeing a lot of new grade A stock coming up, and so this is a temporary thing where the vacancy may be temporarily sort of skewed, and the rental outlook, while it's being noted as under pressure, it's still at 3% year on year. And depending on the building you're in fact, like CBD, there are not a lot of new assets. So depending on where you are from a location standpoint, the micro markets can tell a different picture.
This is a very interesting slide to just cover all the cities. I guess at this moment, correct me if I'm wrong, Sarthak, we are focusing on Mumbai, Bangalore, Pune, and Delhi NCR to be talking about. Is it correct? Or we are looking
So
at
yeah,
Chennai, Hyderabad as well?
so today's discussion will be Mumbai, Pune, Bangalore, which has
Okay.
been sort of where we've prior invested in the past.
Hmm.
That being said, of course, just so the broader group and our visitors here are aware that we're also looking at assets in NCR and Hyderabad, and so forth, where we are seeing a lot of good quality emerging, right? So we won't talk about that today, but once we maybe in
Sure.
the next sort of webinar, we'll come to those cities as well.
I'm sure. So let's do a deep dive on the Bangalore market. Well,
Sure.
you can take us through the Bangalore market.
Correct. So, this is just Q2 data, and what we were looking at earlier was, I think, for the full half year. But Q2 saw 5 million square feet of leasing activity in Bangalore, which is incredible, right? If we look at total office stock in India, grade A office stock being about, say, 800 million square feet, we're seeing this much gross leasing activity happening in Bangalore as well. And vacancy has been really dropping in Bangalore. And when we talk about the micro markets, we'll explain a little bit, but seeing a lot of new large occupiers continue to take up more space. Apple has taken up a really large new location. Google has towards the Whitefield area. And so we're seeing still, even the people that had presence there already are continuing to expand. And so the outlook there is that the vacancy levels, sub 10% vacancy level is a very, very strong signal. And so we also see that the rentals here in Bangalore, they're still a little bit close to $1, depending on where you are. If you're in Whitefield, where most of the tech operators in that outer ring road, Whitefield area, it's generally hovering from say 70 rupees to about 130 or so rupees per square foot, which is just about $1, $1.50 type of range, which means that that's still going to stay competitive from a GCC standpoint, and more sort of GCC expansion is likely. Now, if we talk about the sub markets, and I'll just give a broad overview. The CBD, where UB City and the core market, this is a pretty supply constrained area where you won't have a lot of good high quality assets. So demand is through the roof, and depending on where you are, CBDs tend to have similar characteristics. But in Bangalore, there's also a lot of land constraint, or a lot of land is leased from churches or trusts and things like that. So the ability to get new high quality assets has been limited. So we are seeing here that the rents, while most reports will mention that the rents are around 160 or so for this area, we are seeing in many of the assets that we look at, rents, tenants are paying 200, 250 range as well for high quality CBD assets. So, this is a more asset specific play. If you're in the CBD, there will be a big difference between a grade A plus, a grade A, and a grade B asset. And so we see that there's not a lot of good stock coming in over here, and hence we'll expect the rentals to continue to go quite high. Outer Ring Road also now, while there will be more supply here, given it's a broader area, but rents are also going pretty high here, and vacancy is also very low given the amount of demand. So I think Bangalore is the two top markets of Bangalore being the Outer Ring Road CBD. Both would be less than 5% vacancy levels, which is extremely strong. And then in the suburban south and other areas, we're seeing large occupiers, right? Where full campuses for a tech company could be there, and so forth. So it's a different type of tenant profile. And here also we expect there to be a little bit more stable, and it's more built to suit assets that are coming. So yeah, broadly we've covered this, right? And I mentioned that CBD, while 160 is the average, we're seeing 200, 250 also, and we expect that will keep continuing. And the momentum, as I mentioned, has always stayed. So with GCCs and overall here, we expect that vacancy will further tighten as well.
Great. So for everybody's benefit, we will be sharing this presentation to all the registered, for the webinar. So this particular Excel sheet is something which will not speak about much, but it will be for your reference. But Sarthak, I see one place over there where I guess we have a property which is CBD of CBD. Is that 4.1% overall vacancy rate? Is it, if I'm correct?
Yeah, that's right. Overall vacancy in CBD for Bangalore is 4.1, where we do have an asset. And here we are seeing that demand is there, but and high quality assets are also more in demand. So when we do see something come up over here, I think within a period of about 6 months, you can expect that that would get released and so forth.
So it's showing a grade A stock weighted average rent as 162.1. So approximately could range anything between 140 to 160, something like that.
Yeah. So actually, I would say this range is more from 120 to say 250, depending on the building quality. And access to metro and other things like that as well are some factors that people consider.
Noted. Well, let's as well, talk about Mumbai.
Absolutely. So Mumbai also, despite being a very developed market from the get-go, has also had a lot of leasing activity, right? And a lot of flex operators are leading the pack here in Mumbai. We're seeing that, and BFSI, of course. So a lot of overall Mumbai, as I would say, that vacancies continue to decline and rentals are, are edging up, right? So this number of 160 or so averages would be more of what we see today in Andheri, on Andheri Kurla Road, etc. Whereas BKC rents are anywhere from say 300 to 500, right? Which is and every quarter we see a new record in BKC that has emerged. That being said, infrastructure is catching up a lot in Mumbai, and we're seeing a lot of infrastructure growth and plans that we should see come to fruition in the next 3 to 5 years. So a lot of operators are now and developers are also planning uh, assets that would sort of coincide with the upcoming metro lanes or the coastal road and so forth. And we are also looking at assets with that lens, right? Because Mumbai land is so scarce, you kind of have to plan for the future. And so that's sort of how we are looking at things as well, making sure we take into account the future infrastructure development that's coming into Mumbai.
But before that, did you say 350 to 500 for BKC?
Yeah, 300 would be the very low side of
Oh,
BKC. And, yeah.
wow. Yeah, please, over to you.
And a lot of new buildings are coming in BKC. I mean, lot is relative to the amount of stock that BKC does have, but good high quality assets are coming to BKC. That being said, because the cost is getting so high, a lot of people are now looking at Lower Parel as a market. A lot of people are looking to even, and we are seeing a lot of traction even in Navi Mumbai. Sort of some landmark kind of projects have emerged that have created a bigger market there as well. And of course, then places like say Malad, etc., where there is still some land available, will see an uptake. That Goregaon area, where Morgan Stanley has taken up a lot of space, and BlackRock as well. So
Hmm.
there are a lot of you're seeing that now a lot of BFSI demand is also moving upwards because to make it more cost competitive for them, right? Like the trophy projects in Goregaon, the rental rates are about 170-ish. Whereas if a BKC is 300, it's almost half. So, I mean, 300 is the bare minimum, I would say. So, less than half in many cases. So we're seeing that as well. And BKC doesn't have supply. So you won't get, if you want to take up a full building or half a building, you won't have the options as such. So those are the things that are driving the Mumbai sort of tenant sentiment.
It's in just as a reference point, we see 11.2% as a vacancy percentage as in Mumbai, wherein, of course, Sarthak correctly mentioned the supply in Mumbai to get is, of course, not much possible. But yeah, exchange point where you can look at Navi Mumbai in some locations, and that is
Right.
why vacancy percentage is only 11.2 if you compare it to other locations uh, in other country in other cities which we look at. Uh,
Right. So Mumbai has some of the least new supply, right? So here, we're working on a few things where we're trying to get more supply as well. But 1 million square feet compared to, I think when we talk about Bangalore, is close to 7 or 8. In fact, Pune is actually at 7 of new supply coming in. Um, so there's not a lot of supply in Mumbai. So rental rates will continue to sort of outpace in Mumbai for sure.
mhm. Well, again, slide which will be part. Anything which you want to highlight of this? What do you think?
No, I think CBD is sort of more of your the town side, Kolaba, Churchgate, etc. And then SBD, BKC is what which now is sort of the de facto main central business district that is there. But you can see here also vacancy rates very low and average rent is 329 as it points out. But we're seeing even things hitting 500 and so
Correct.
forth. And even Worli, in fact, has caught up. Some projects in Worli have really come in and they're coming close to BKC rentals as well. As you see, that's averaging at around 318. Less inventory here, but we should see more inventory in the Lower Parel area a little bit, in the BKC area a little bit, Andheri Kurla is seeing a little bit more. And of course, yeah, so Lower Parel and if we see the sort of planned under construction, right, Andheri Kurla, Powai, really driving it, and BKC, there are 2, 3 new buildings that should bring a lot of new supply as well. But we don't expect that it'll have any impact to rental rate. It's they're already probably pre-committed in many cases.
True. Something. Let's go into Pune as a location. If you can give me your insights.
Sure. So Pune has seen a lot of good traction as well. In fact, it tracks closely like Hyderabad, where a lot of GCC demand has also come in. And Pune, we're seeing a lot of new buildings coming in, but but a lot of good engineering, manufacturing-led growth there, professional services. Of course, there's a lot of automobile manufacturing and so forth in that broader Pune area as well. So we see a lot of that kind of tenant profile come in. And the vacancy is rising a little bit, as I mentioned, because of the new supply. But depending, there's a lot of flex demand in Pune for flex operators. So even if that new supply comes in, we're seeing almost full buildings get taken up at much faster paces here than in other markets. Right. So CBD, not a lot coming in this area, of course, and Shivaji Nagar, Koregaon Park, etc. Are still a supply, sort of very little new supply coming in. More of the supply that we see is coming towards the Baner and sort of that area. But overall, while there'll be a lot of new supply in Pune, I think the rents may not increase that drastically at 5% plus level, but we should see at least 3%, 4%, and then it should stabilize in the next 2, 3 years. Whereas CBD, I will say, will still be stronger and outperforming because there's no new supply there. Pune has sort of scattered markets, and CBD is the central area where there's not a lot of new supply. So rents there should be steady and increasing.
Noted.
Right, and here that's Pune offers that competitive advantage also because rents can be sub-dollar in many cases, right? So where you see PBD West of 62.1, so a lot of GCC demand is also coming in here. As Bangalore gets more and more expensive, we see that this could also have some potential, and the rents of the 62 number tracks closely with say what Hyderabad rentals are also at. So both these Hyderabad Pune should sort of grow in that similar sort of outlook as well.
Something to highlight on the particular structure and the locations in Pune?
Yeah, no. So as I mentioned, CBD, there's just not a lot of inventory, right, compared to some of the other markets, and even sort of under construction, we'll see it coming through, but this is all maybe about 3 years down the line. So that shouldn't really impact our rentals in the near term.
Noted. So, since Sarthak, we have covered Bangalore, we've covered Mumbai, we have covered Mumbai. These are more of a statistical insights which are given. Anything takeaways which you want to give to our investors? Let me just check if we have any. So this is
So
something which we'll surely talk after this. But yeah, any
yeah,
insights which you want to give to our investors or our
sure.
partners who are basically tied up with us and are investing with us, how we kind of generally get the particulars. These are statistics which we look at surely for
Yeah,
acquisitions. But at the same time, at AgeWitz, what do we look at generally,
yeah.
overall view and your insights, please?
No, absolutely. So, of late, we're seeing that a lot of tenants want grade A stock. Then they want also like green buildings and ESG compliant sort of buildings and so forth. So we're seeing that you could be in say Andheri Kurla sub-market of Mumbai, which is also a very hot in demand market. But the kind of rental that a grade A property will get versus a grade B can vary by 60-70% on the same road. So what we tend to see now that most occupiers, both domestic and sort of global entities, MNCs, etc., are looking at more high quality assets. So if we're getting something at a very attractive yield, but it's not a high quality asset, we're not really looking to sort of invest because our goal is to invest with minimal risk. That right, we're comparing our investments to be against fixed deposits and so forth. So we want to invest even if it's a slightly lower yield. Uh, we want to invest where we believe that potential sort of decline or vacancy, etc., will not happen, right? And so, or if it does go vacant, we're able to release it within a reasonable amount of time, right? Which can be about 6 to 9 months is traditional for real estate in India at least. So that's sort of the main takeaway of late. We are seeing, and also what we're seeing is that full new buildings are not necessarily readily available because land is scarce and so forth. So a lot of times we're seeing retrofitted opportunities, or you take something where maybe we can plan a facade upgrade, and that building can then become a grade A plus from a grade A. right? So we can take those things into account, and all of our underwriting is now taking those is making those calls that because we're looking at full buildings now, that we can account for some capex like that, where we do up the lobby, we do and this is the kind of investment thesis that Blackstone actually has always followed, right? They take something and they make marginal improvements and then they really turn the rent up. So
Good.
so that's the thesis that we're looking at from EdgeBit's angle of what to invest in, how to invest in, and yields are generally compressing. I will say that, but I think good quality assets will give a good IRR in the long run,
Mm,
even if the yield is slightly lower on an entry basis. Right, we can compensate for that over the next 2-3 years.
I was just going to say that. So it looks like the ROI could be a challenge for a short time, but the IRR
Yeah.
is something which you can really vouch on. But the time horizon to be invested in this particular product should be at least between 3 to 5 years.
Absolutely, right. From what we are looking at from a hold period perspective, because there are two natures of leasing models of escalations in India, typically 5% year on year or 15% every 3 years.
Correct.
And so, the 3 years or 6 years, ideally, we believe that to capture good value, you want to hold it between 7 and 10 years. And
Noted.
that's when you get that IRR that you really want to achieve, right? So and the yields, I mean, they're compressing while sellers may be asking at 6% rates, 6.5% rates, but we are seeing that a majority will trade around between 7 and 8 or 7.5, 8. And so for these are for high quality assets that I mean, like 7.5 is something that the number is trending towards that of late for high quality assets. And we figure out how to structure that, but we believe that these assets that we're going after, there's a lot of other people that are also going after it, that is also slightly compressing it in terms, and then also more and more people are looking at alternative investments, right, of late. So good demand is there, and at least from our perspective, we are always looking at both upside IRR, downside IRR, base case IRR, and we make sure that we get a good IRR even if we take a slight lower entry yield today.
Noted. Well, I know this was more of an information as in any kind of to be given to the people who have joined us. But people, if you have any questions as such for us, please feel free to ask us right now. We'll be more than glad to answer. Just to talk about, we have few questions which are already in. So there is a question from Mr. Sharath Atre. If Trump introduces the Hire Act, um, halting international relocation of employment and imposes 25% tax on certain payments US companies make to foreign persons, overseas workers and firms for services that benefit US customers, will it impact the leasing of office spaces in India? Well, yeah, Sarthak, over to you.
Sure. So actually, I mean, this question, of course, in the tariff era, we are seeing a lot of this speculation. But broadly, if whatever comes in, it'll be highly detrimental to the U.S. economy if tariffs are imposed on services being rendered in India, right? So should that even happen in some way, and I apologize, I've not read too much into this specific act, but international relocation of employment. But what from the GCC demand, for the most part, it is usually global companies, but they're hiring Indian workers. So I'm not sure if there's an impact from relocation perspective. But from all the sort of from the years we have to the market, we are not seeing any sort of slowdown in terms of GCC demand. Um, Maybe just marginally while this quarter, even though the tariffs were going on and other discussions, we've still seen high leasing activity. Secondly, the shift actually in this quarter has been more domestic leasing from domestic firms than GCCs. So given the vacancy rates being so low anyway, and the continued demand from a domestic side, we don't see any impact to the office market uh, at present. And even if there's a temporary impact, most of these companies have substantial, cash reserves, and these leases are usually long-term leases that they enter into, like 9-year leases and so forth. So whatever temporary disruption we may have, it won't affect any of the rental stream. It may affect temporarily what new GCC sort of demand is there, but I mean, not it's. I don't think it's wavering anything. For example, Morgan Stanley has taken up maybe 300,000 square feet or so in Goregaon that I mentioned. JP Morgan has got an RFP out for another sort of that size in Bombay. So I don't think anything is slowing down that impact at the moment.
Mm-hmm.
And the rental rates are still, sub dollars. Even if there is some kind of tariff impact, etc. You're talking about still a 1/50th the cost of US real estate, or 100th the cost of US real estate.
Agreed. So I have a question from Ankit Gandhi who says, do you buy a new property or used property? Also, you can buy.
Yeah, sure. So we everything actually both, right? We're looking at new properties as well, where they might be currently under construction, and we work to with a timeline in mind with the seller, so that the tenant and the building is ready at the same time, and we purchase it. But a majority that we see is used properties, right? Because in pre-leased, that's the bigger chunk of the market, where it's already leased to someone, it's an already ready property. That being said, when we look at a certain threshold, maybe the building is within 15 years old or so. If it is more than that, then we would plan for some capex, right, which I mentioned earlier. So, and you'll be surprised. You can take a 30-year-old building, but the structure is so sound. If you redo the facade and lobbies, etc., it becomes a grade A plus asset immediately.
Agreed. Well, I'll still request people to put in questions because we don't see much of questions over here. Well, Pooja, to your question, you can write us an email at Abhimanyu. You can take out the spelling from here at hbits.co or Sarthak at hbits.co, and we can talk about your question offline. Well, Sarthak, and to people over here, it's very important place where we look at the real estate to in a very a funnel manner. And to the effect, it's not just the ROI. People in investing, they forget one of the most missing important item, which is the entry price point, which is again very important to us, which actually makes you achieve the IRR. Uh, to give you a little background to it, so we did our first exit. In the first exit on our brochure, we had mentioned targeted IRR to be 15.54, and we achieved 17.54. On the second exit, which we did this year, a month, couple of, I guess, 2 months back, in that particular brochure, we had mentioned targeted IRR to be 13.10, and we have delivered 14.74. Correct me if I'm wrong, Sarthak.
Yeah, it was about 14 point. Yeah, correct, 75. Yeah.
Right. So that's the idea, and that's the expertise what is got from the, at the time of entry point. So these are some high quality assets, a lot of negotiations, a lot of analysis, a lot of deep dive into a particular asset, a lot of location checking, a lot of legal check and everything. And that's how the product is presented to you for investing. Well,
Yeah. So maybe there's a question here from Jagmohan. I want to
right.
take that. So Jagmohan asked if our focus is more on Bangalore, Pune, and Mumbai. Why not other places? Noida is coming up with a lot of activities, and third international airport, lots of industries, etc. Film city, IT hub. Absolutely. So in fact, I was in Noida and NCR just about 10 days back. So we hadn't in the past because we didn't know that market necessarily at that time. Now we are working hard to sort of explore that market as well. In fact, Noida, we are currently evaluating about 4 to 5 assets in Noida, and would be happy if you have any leads. We are certainly looking at Noida as well, Gurgaon, NCR in general. Also looking at Hyderabad, and also we're open to other cities like Kolkata, Chennai, Ahmedabad, Gift City, all on the radar. Just basically in tracking with how the demand is moving for office. We want to start with the largest cities first, and that's why being Mumbai based, Bangalore, Pune, Mumbai happened first. Now we will certainly be looking at doing something in NCR, Hyderabad as well, and then moving on to other cities. And if there are any references or leads that any of you have, be it Ahmedabad, Gift City, Hyderabad, we're more than happy to explore. And Abhiman, you mentioned that you can reach us on just, so for me, it's just sarthak at hbits.co. And you can send me an email.
And Pooja, I guess your question is answered. How about Ahmedabad market? So that kind of covers the entire thing. Again, anything, Sarthak, you want to just point out and give us as information?
No, I think we've covered a good bit. We'll certainly look at doing in the next one we do of these mini bite-size markets. We can look at doing the Hyderabad, NCR, Ahmedabad, etc. Some other markets like that we talk about. Ankit has one question. In
Correct.
old commercial building, there are multiple owners. So how do you deal with that? So, Ankit, a good question. Usually, when we're looking to acquire, either we're buying a few floors or we're buying the full building, right? And there may be multiple owners in the past, but we would buy them out at the same time, right? And so ultimately, moving forward, once it gets acquired through EdgeBits Investment Trust, and we do it the SM REIT route, then those old owners would be paid out and sort of exit the property. In some cases, we could acquire half the property, a few floors, and other owners may coexist, and that's fine. We would just be concerned with our own units in that case.
Just to give you a range-bound check for SM REITs, we do any property starting 50 crores to 500 crores. But at this moment, our outlook is, of course, above 200 crores to 500 crores.
So I'll add that, Abhimanyu, we are looking at over 500 crores as well, like 1,000 crores, 2,000 crores, up to 2,000 crores rather. Because while SM REIT is limited to 500 crore per scheme, we can do multiple schemes at the same time. Yeah.
Right. So anything above 200, 250 crores?
Essentially, yes.
Perfect. Sounds great. Any other questions? Great.
Great.
Well, again, thank you everyone joining us at this afternoon for a particular different topic altogether, which is again a very core topic at EdgeBits. Thank you, Sarthak, for joining in. While we go, there is a question from Chandigarh. What about Chandigarh? Yes, we are looking forward to do that. And to answer the question, if they want to withdraw, I guess say the timeline period is somewhere between 3 to 5 years. But it all depends on the cycle, which Sarthak correctly mentioned. To give you an example, we did a ICICI property, Akruti Center Point, wherein the cycle is that every 3 years there's a 12.5% rental escalation. So we might look at after a 6-year kind of a scenario with a second escalation itself. Yeah.
So just to add there though, that would be around that cycle, say 7 to 10 years to exit an entire property that we might look at now for new acquisitions, or say 5-6 years, for 5 years roughly for the older ones. For an investor to exit, right, there are two ways. Under the SM REIT, because they'll be listed units, the particular investor can exit their share at any point, and in fact, the share price would of their units would increase year on year because the rent is increasing year on year by say 5%, etc. So at the very least, you'll get that increment. Although we recommend that investors hold on till we actually exit the property, because then you can get a much better increment for your investment. I think you're on mute, Abhimanyu.
Yeah, sure. Thank you again for joining us this afternoon. Thank you, Sarthak. I look forward to having the upcoming webinar. I guess we are in September, mid of October. Again, we're going to pool in, and I'm sure we'll have the specs of the IPO, which will be coming in couple of months from now. So we'll take you in again and invite you in for the webinar for all the people who are present over here.
Great. Okay. Thanks, everyone. Thanks, everyone. Yeah, take care.
Thank you. Bye-bye.